Well, good morning, everyone, and welcome to the Atlas Merchant Capital Fall Quarterly Update Call. I have with me today, as is tradition, Bob Diamond, who is our co-founder of Atlas Merchant Capital and CEO, and Larry Cantor, who's the chief economist at Atlas Merchant Capital. Fellas, a lot has gone on since we last convened. Some of the things that come to mind for me are the fact that the Fed acted and broadcast what they were going to do, and that was a 25 basis point cut in the Fed rate. Tariffs are kicking in now. We're starting to see the effects of those, and we'll have some real questions for both of you in terms of how that impacts the near-term economy, especially with this being the holiday quarter. Unfortunately, we still have war raging in Eastern Europe and in the Middle East and elsewhere, although some fires have been put out. We're seeing a rise in the U.S., at least, of political violence, of increasing intolerance. Seems to me that both of those things are on the upswing. Anecdotally, but I know, Larry, you'll have some real data. The job market seems to be softening, and we have, as reported in the summertime in the Wall Street Journal, that the largest companies in America are now reporting a 3.5% decline in payroll over the last 3 years. That means headcount. And they're forecasting continuing declines in headcount. It seems to me that the mantra of, oh my goodness, I can't hire enough people to keep up with our growth has shifted. And now the attitude is we all need to do more with less, and we should be proud of that. So I wonder how you think, both of you, how you think that impacts near-term the job market, the prospects for impacts on education. Are we doing the right things to educate young people? Are we giving them the right skills in this changing market? Immigration has, at least in the U.S., has frozen, both legal and the illegal immigration. I wonder what the consequence of that will be in the next quarter or two. And then the big question that, Bob, I know you're keenly involved in, and Larry, you're measuring the impact and have a point of view about, and that is technology. We have AI really making an impact now. We have the impact of crypto and blockchain, with which, Bob, you know so much about, and Atlas Merchant Capital is in the center of. We have on the horizon a real influx of the impact of robotics and quantum computing that makes all of these technology changes go all the faster. So, Bob, let me turn to you first and ask you about something I've asked you about probably each of the last 4 update calls, and that is regional banking, community banking. We saw back in September John Gray, who's the CEO of Blackstone, in his very thoughtful investor presentation, echo your thoughts and sentiments, Bob, about community banks, their role and importance in our economy. And he was forecasting that there'd be consolidation. So you and John Gray are singing out of the same hymnal here. He talked about, as you have on all of these calls, the increasing cost of spend for the regional and community banks on technology and all the regulatory requirements driving consolidation in this very important sector. So, Bob, let me turn to you first with that question, which is what's happening in the regional bank and community banking markets. We did see an announcement just recently that Fifth Third is acquiring Comerica in a $10.9 billion deal. Bob, what's going on in that marketplace?
Consolidation, Jimmy, and I think that consolidation is good for the economy. I think it's good for banking. I think it's good for competition. I think it's good for consumers. But today we have 4,500 banks in the U.S., and that's just the wrong number. I think we should be somewhere around 1,000, and I believe that consolidation will happen in the next 2 to 3 years.
That much? Wow.
Just under 50% of lending to small businesses in our country come from those banks, not the big 4. I think it's critical for our economy, critical for our communities, and many of the more private, smaller community banks today, Jimmy, are just too small to succeed. The way to get the ROE up is consolidation, cost savings, in-state, close to state. I think it's a bellwether that we saw the Fifth Third and Comerica. That's higher than the level we're looking at with regional banks and community banks. Brian Saunders is leading our effort there, and we're looking at the 3 billion to 50 billion area in terms of assets.
And Bob, when you say
Brian
we,
and
Atlas Merchant Capital raised a fund just
right.
to aid and abet this merger and consolidation thought that you think needs to take place, will take place, and is to the benefit of businesses, therefore the economy of the United States.
We have a strategy here, and as you said, we are acting on that. We welcome other interest from people, but most importantly, Brian Saunders and David Seamus, who are leading this effort, have visited with over 60 CEOs and CFOs of banks in that area, that 3 billion in assets to 50 billion in assets. There isn't a single institution that doesn't recognize the importance of consolidation. But here's the kicker: this administration is endorsing it. They're looking at banking with simpler capital rules rather than more complicated, as we've seen for the last 15 years. They're looking at banking and saying consolidation is good. We will likely approve these mergers and move quickly to improve them. And most importantly, they said there's one set of regulations for banks, whether it's a digital bank or crypto, or whether it's a traditional bank. Not only will we have robust regulation, but we'll have one set of regulations. So the tailwinds behind this initiative for the CEOs and CFOs is large, and you'll see a lot of activity here over the next 2 to 3 years as we move from 4,500 banks in this country to something closer to 1,000. And I think most importantly, no one is more prepared here than Atlas Merchant Capital with what we've done both in distress and in peace times with banks. David around IndyMac and others, ourselves at Barclays Capital with Lehman Brothers and others. We know what we're doing in this space. It's highly regulated. Eric Rosengren, former president of the Boston Fed, has joined the team. So we're very excited. This is a great opportunity, and it's right absolutely down the fairway of what we're good at.
Thanks, Bob. And continuing on that theme of the regional bank consolidation, one of the things that you've talked about and John Gray mentioned was the spend on technology and how that was smaller banks just can't afford to keep up with the regulatory environment or the technology environment. You've invested and put a lot of effort behind crypto and blockchain. Bob, for us laymen, how will the implementation of blockchain change banking? And what role will crypto play? Will it have its roles side by side with fiat currencies?
Yeah, I think it's a very, very important question today, Jimmy. And I think also we have tailwinds from this administration. Under Biden, Gary Gensler in the SEC was no, no, no on anything to do with consolidation and finance, but no, no, no on anything that was away from mainstream. I like to call it digital assets rather than crypto. I think it's more descriptive. And I think we're in an evolution today, not just digitizing banks, but really looking forward to creating maybe the first digital bank. And no one can argue today the strength of blockchain as an underpinning technology. And thank goodness we had the experience in 2021 and 2022 to really understand the workings of Circle and the value of blockchain when we were trying to de-SPAC that institution.
Well, you were
Luckily,
really
we
early
saw
there.
and we're able to invest in a valuation that was much less than we were looking to take them public in. And so that was great for our investors. But more importantly, it taught us a lot about blockchain, stable coins. Who can argue about whether we're going to have an institutional digital version of the dollar? Of course we are.
Hmm.
It's going to lessen costs of banking. It's going to democratize banking significantly.
Speed things up too, no?
And our view here, Jimmy, is within 5 years, maybe 6 or 7 years, blockchain will be the prominent underpinning, technology underpinning of financial services writ large for all the banks around the world. And I just came back from the Middle East. We're visiting a number of countries there, and a lot of the smaller banks, very successful banks in the Middle East, are already employing blockchain.
Hmm. So that leads me to you, Larry. This is an area of core expertise for you, having worked at the Fed. Maybe start there with Bob's point about where we're going with digitization, and I'll introduce another word. And I'd love to hear, love to get educated by you guys on its impact. But tokenization, we're talking about tokenization of. We could buy 1/100th of a painting. We can buy 1/100th of the cash flow of a particular office building from its services side. Digitization slash tokenization of everything. Larry, let's start small and then please take us large in terms of the things we've talked about just in our opening today about the impacts on the market. Help us, Larry. Help us.
Well, I just want to back up something Bob said about consolidation and just say, I mean, he's absolutely right. We are not going to have 4,500 banks uh, going forward. But this has been going on since 1990. You know, the banking crisis back then of small banks, the savings bank crisis. We had almost 15,000 banks, and we're down to 4,500. So this is something, as Bob said, this is administration's making it easier, but this is something that's happening. And like I said, Atlas has a lot of, like Bob said, plenty of expertise in this process. In terms of, blockchain, look, this is a great technology. I will say, I think when you're talking about things like Bitcoin and those tokens, I think they'll end up just being a speculative asset. But the blockchain technology is real, and we will have, as Bob says, digitized currencies. The central banks will get involved. This is clearly the direction we're going and why we're investing in it. Usually I just talk about what's going on in the economy and what it means for markets, but we've got a few things going on that have to be addressed. We're in the middle of a government shutdown. I want to talk a little bit about that, what it means. And we've got the most blatant attack on the independence of the Fed that, at least in my lifetime, I've seen. And I think it's important to talk about that also. But, I won't let go of the economy and markets. So I think probably everybody realizes that shutdowns reduce economic activity, but they don't last long. Markets rebound very quickly when they're over. And so basically, if you look at the effects on financial markets, whether it's the dollar or bonds, you go over time when there have been shutdowns, it's had no effect. And I think the markets just look through that. Even though the short-term impact can be pretty big. I mean, we're estimating that the number of federal workers being furloughed is about 750,000. It's not a small number. They're on unpaid leave. They're actually, people don't notice, they're barred from working. So while they're on leave, they can't actually
I didn't
work.
know that.
Essential workers are required to work without pay, but all of them get back pay when the shutdown ends. Now, estimates of while the shutdown's going on, what does it cost the economy? It's about a 0.5 percentage point of GDP a month. Now, the current shutdown could cause more permanent damage if President Trump follows through on his threat to fire instead of furlough many workers.
Well, a couple of things sound screwy there, Larry. One is they get paid even though they don't work, and B, they're not allowed to work. And then maybe C, those workers who are required to work, but they don't get paid. None of that makes sense.
Oh, no, the guys that are people furloughed are not paid, but they get back pay.
That's what I mean.
Right. So well, those are the rules. You could say, I mean, they're not stepping out of their own volition, obviously, but they're also prevented from getting another job. So, it sort of does make sense, I think. Anyway, going to the economic data, we all know the September employment report wasn't released last Friday. It's interesting because the data had already been compiled and the reports were written up. I mean, the shutdown happened only couple days before it was going to be released, but they didn't release it. This week would be light on U.S. economic data anyway, but next week we're supposed to get retail sales and the CPI, and if the shutdown's going, we're not going to get them. Nobody knows how long this is going to last. Very few, if you go back and look at them, last more than a few days. The longest was the 35-day shutdown in President Trump's first term. We have betting markets on everything these days. So if you want to look at those, the highest probability is 10 to 29 days. But one thing's clear, however this thing ends, we are not going to be reducing our deficit and debt anytime soon. I mean, if the big, beautiful bill was just left alone, it would increase budget deficits to around 7% of GDP. They've been running about 6% in recent years, which are already the highest non-recessionary budget deficits we've had since World War II. In terms of debt, we're already at a record $30 trillion in U.S. debt. By the way, it was $5 trillion before the financial crisis. Under the current bill, it's estimated to add another sort of $3.5 to $6 trillion over the next decade. And if you add to that, what are Democrats holding out for? They're holding out for an extension of the healthcare subsidies for the Affordable Care Act, which are due to expire at year end. And if they are extended, that's going to add even further to both budget deficits and U.S. debt. So we're not getting any fix on our debt problem. Now, the outcome obviously is more of a political issue than an economic issue. But I should point out that if you read the political winds, it's sort of leaning to the Democrats at this point. And here's why. There's 24 million people that are enrolled in the Affordable Care Act, the healthcare insurance that's provided by it. If it's not extended, premiums will rise by an average of 75%. Most of these people actually reside in red states. The enrollment period begins very soon, and insurance companies are already sending out notice of higher premiums. We all know that most Americans, when they're polled, say their biggest issue is the cost of living. It's also, the polls recently blamed the Republicans more than the Democrats for the shutdown. So, it's looking like there'll be some compromise and the Democrats will get at least some of this, although, as you know, many Republicans are fiercely opposed to the extension because they've been trying to kill the ACA for the 15 years it's been in. So,
Larry, is this time different? You mentioned that during the first Trump administration, there was the longest shutdown, 35 days.
Yeah, right.
One of the things we're saying is he's doing things. President Trump is doing things differently in this 4-year term than he did in his first term. And is this time different in the sense that he's going to take actions to change government and change policy with the stroke of a presidential order that's different than maybe we've seen before? Is this time different?
Jim, that's a very good point. I think, I'm not sure how this. I'm just saying, if you look at, and President Trump even said the other day he's open to negotiating. And supposedly, when the Democrats met with him, and it was a bipartisan meeting, Trump was more sympathetic to doing something about this. Why? He does care about his polls and how he's viewed, and raising the cost of living significantly on 24 million people is not a good look. So I don't know. I mean, look, I don't claim to be a political expert. There may be some on this call. But again, if you look at just the facts, how many Americans, fact that they're in red states, Republicans in the Senate apparently have been talking to Democrats about doing something, although they're insisting that the negotiations happen after they reopen the government. So I don't know. I mean, people do not like government shutdowns, especially when you start seeing, things, all these people not working, and we're not getting data. By the way, that wasn't true last time. Last shutdown, that 35, we were getting economic data. That's because the Congress had passed some things for some departments, so they kept putting it out. So the Fed's now in the dark. investors are in the dark. We'll be getting a little data that's released by the private sector, but not much. So let me get to the economy, because I think that's important. I think you mentioned, Jim, it's been very resilient despite this dramatic weakening in the labor market. I mean, we've talked in the past, higher tariffs and reduced immigration, reduce output and raise prices. But there's something else going on here. And Jim, you alluded to it, and that is an enormous amount of investment in artificial intelligence. And I want to give you just a sense of its impact. So if you look at the first half of the year, the economy grew 1.7% at an annual rate. A full percentage point was contributed by investment in artificial intelligence, which is unbelievable.
And what is that? Where does that investment look like? Where is it going?
So let me get to that. So the demand, what's happening is the demand for computer capacity exceeds supply. So there's a new term, at least I learned, maybe you guys will know, called hyperscalers. So what are those? These are firms like Meta, like Google, like Amazon, like Microsoft, like Oracle. And what they do is provide large scale infrastructure and services to users of AI. And they are ramping up CapEx by literally hundreds of billions of dollars. And if you add to this, when you're looking back at tariffs, we all know they've been delayed. I mean, we also had a surge in imports before the tariffs occurred, which helped to moderate prices because importers had so much inventory. We had a 90-day pause in reciprocal tariffs, another 30-day extension. So right now, this is why you're just starting to see it in the data. Right now, if you look at the average tariff rate, it's between 10 and 15%. It was 2.5% before the inauguration, but it's way below the 25% plus that was announced on Liberation Day. Also, maybe you noticed, maybe you haven't, but the president's been these legal challenges has all been on reciprocal tariffs, on countries. He's been shifting toward individual products, cars, kitchen appliances, that kind of thing. And so what that means, it's going to end up a lot higher. And if you look at inflation forecasts for whatever they're worth, they're all showing higher inflation if the rest of this year and into next year. In terms of reduced immigration, as you mentioned, Jim, there's no labor force growth this year. And that's not a surprise. I mean, I think I mentioned last time, almost 90% of the growth in the labor force over the last 5 years was due to immigration.
And you also talked about the impact of demography and birth rates.
Right. That's right. And that's a major reason why job growth has slowed so much also. I should add, not only job growth, but it's a powerful restraint on economic growth. Everybody talks about, you remember in your Eco 101, GDP is C plus I plus G, consumer spending plus investment spending plus government spending and net exports. There's another way to look at GDP, and that's the supply side. It's basically labor force growth times productivity growth. So when labor force not growing, you don't get as much economic growth. Now, having said that, all this investment in AI is expected to increase productivity growth, and that'll be an offset for economic growth. Whether it's enough to offset the stall in the labor supply is another thing.
What did we learn from Japan on that note?
Yeah, sure. That's a very good point. With their stock market too, they think it was declining for 20 years or something. It's unbelievable. Anyway, we didn't get the September employment report, as you all know, but it's still clear, as you said, Jim, that job growth has slowed dramatically. We did get the ADP report because that's a private payroll firm. Doesn't have the coverage that the BLS one does, but they not only showed a decline in jobs in September of 32,000, but the August number was revised from a plus 54,000 to a minus 3,000. And even if you go back to the August employment report, which we got a month ago, that also showed a huge downward revision, if you remember, in employment growth over the past year. And the 3-month moving average was only 29,000 3 months before it was 100,000. Before that, it was 200,000. So we're getting a lot slower job growth. Now, one thing is interesting, I think. While firms aren't hiring too many people, they don't appear to be firing them, at least yet. Jim, you could be right that that's coming. But if you look at jobless claims, that's one of the few things we're still going to get, because states report jobless claims, weekly people filing for insurance for losing their jobs. Those are still low. There's a JOLT survey. I won't get into what that is, but it shows a very low layoff rate. And despite the weakening in the labor market, the economy is holding up. We have a lot of data for the third quarter. If the shutdown continues to the end of the month, we're not going to get the first GDP report. All the estimates are centering, believe it or not, around 3%, which is almost double what we got in the first half of the year. And why is that? It's this AI spending. So far, the AI spend is outweighing the negative effects of tariffs and immigration. What's not clear is how long this can continue. There's one thing I want to point out that I think is very important, and that is we've got a very high level, obviously, of AI investment. For this to continue to support GDP growth, which is what everybody cares about, not the level of GDP, you need that spending to keep increasing. Okay, if it just stays at this level, there's no contribution to GDP growth. So how long that's going to be when they're spending already hundreds of billions is anybody's guess. But if it pulls back a little, that's a really serious problem for the economy, because we're just starting to see the impact of the reduced immigration and the higher tariffs. So there's no signs that they're slowing it down yet. But
Bob, on that point that Larry just made about the difference between GDP growth and GDP, give us a little color on why that matters. We have an enormous GDP in the trillions of dollars.
Yeah.
How many trillion, Larry, in the U.S.?
It's over 7.
So $7 trillion annual GDP. Bob, why does it matter if it's 7 trillion this year and 7 trillion again next year if there's no growth? Why does that matter?
I got to go to Larry on that one.
Yeah. Well, I mean, it's interesting, Jim, because when it's not growing, the problems, the long list, this is a huge list. I mean,
built-in inflation.
We've got, look what happened in Japan, basically. You end up with, everybody talks about let's bring prices down. Deflation is much worse than inflation because it's harder to control.
Yep.
Even zero interest rates, if prices are going down, real rates are up. So you want to save because you're going to not spend because prices are going to go down. So when things stall, it's a very dangerous place to be. And you mentioned Japan's a great example where for 20 years, nothing was growing, prices were falling, and they had a stock market that, I think we'd all be upset if for 20 years stock prices didn't go up. So you want
20 minutes would be bothering us in this country.
Yeah, exactly. So let me just because I don't want to take too long. I just want to go over the Fed and what's going on there. In a way, I've said this before. When you think of reduced immigration and higher tariffs, that's a problem for the Fed because it means higher prices and lower output. And you sort of have opposite policy reactions from that. Now, the Fed, you probably know, Congress has given the Fed a dual mandate. The dual mandate is maximum employment and price stability. Lately, what's been happening? We've had very little rise in inflation for the reasons I've explained. It's been a delay. And we've had a huge drop in employment. So the Fed did cut rates on September 17th. It was the first rate cut this year. And the last meeting included policy projections by the FOMC, which was interesting because there was a huge diversion in views. So there's 19 people on the FOMC. 7 of them said no more rate cuts this year. 2 of them favored one more rate cut. So that's more than half. 9 of them favored two more rate cuts. There was one guy, Stephen Moran. He was recently appointed by President Trump to fill a vacant seat. He forecasted 150 basis points in the next 2 months, till the end of the year. Nobody believes this is going to happen.
But if the data isn't being accumulated, how does the Fed make their decision?
Exactly. No, it's tough. Now they do have. We were talking about this the other day, Jim. Regional Fed banks, and each of those regional Fed banks have staff that look at their local economy. So the San Francisco Fed focuses a lot on Silicon Valley, Kansas City Fed on the agricultural sector, et cetera. So they do get information, but you're right, it makes it much more difficult. What are markets pricing in? 94% probability that they cut at the end of October, which is their next meeting, and it's going to happen. I mean, they know job growth is weakened, and so far the economy is holding up, so they're cutting rates. The probability for the December meeting, this is the last one of the year, is about 84%, which in my view is a little too high, given, I think there's maybe 50-50 on that one, or maybe they hold. We'll see what happens. It's worth mentioning the current target rate, which is 4 to 4.25, is only mildly restrictive. I mean, it's pretty close to neutral. Now, I got to talk about Fed independence. Everybody's worried about it. There's been an overt attack. There's no other way to put it. There's no previous president who has attacked the Fed chair and its policies in such a public way. An independent central bank that's immune to the short-term pressures to stimulate the economy is absolutely critical to the stability of the economy. There is overwhelming empirical evidence that central banks that are controlled by politicians lead to very bad outcomes, mostly uncontrollable inflation, currencies that become worthless. It's very dangerous. And the president has not only tried to influence Fed policy by verbal attacks, but also by trying to put people loyal to him on the Federal Reserve Board. I just mentioned the appointment of Stephen Moran. He's actually the president's chairman of the economic advisors. This has made him the first person ever to be sitting on the Federal Reserve Board with a job in the White House. I mean, he's taken temporary leave, but that's his job. He was the only FOMC member to vote against the Fed's decision, which was 11-1 to cut rates by 25 basis points. President also, as you probably know, it's been in the papers, tried to remove Governor Lisa Cook from the board. The Supreme Court has delayed that decision until they hear arguments in January. I just want to also say that this is not going to be easy. I mean, presidents have a huge amount of power, as we've all observed. Fed chairs, the staff, almost all the presidents of the Fed, regional banks, all of them cherish its independence. I worked, as you mentioned, at the Fed under Paul Volcker. I'm just telling you, political bias in any way was simply just not tolerated. They still have that culture at the Fed. I think, if you saw the 11-1 vote, that tells you something about the Fed. There were very different views on rates. They want to convey consensus because they want people to be confident. They want credibility for the markets. So that's the culture. So it's not, I know, again, presidents have a lot of power, but putting the Fed under control of the executive branch of the government will be strongly resisted by Fed officials. Hopefully also by the judicial and legislative branches, but we'll see. I probably, because I ran so long, we could talk about markets. I'm happy to do that, but let's just open it up, Jim.
Larry, I think it begs a question from all of us about if all of these things are going on at the same time, shutdown, wars, and yet the threats to the job market, the economy seems to be going along pretty well. We've had 11 recessions since the big crash of 29, none of which have tripped us into a recession, into a depression.
Right.
So should we feel fairly comfortable with all the uncertainty going on around us that somehow the economy will muddle through?
I don't feel comfortable. I think
Well, that's
Pope
that's the question.
Yeah, I mean, the reason is that, when you dig into this, which I did, I mean, I usually have lots of data. I still do. It's just that just the last couple of weeks, we didn't get the last employment report so far. That's the only one. But you dig into it and say, well, why is this happening? This reminds me a lot of the internet, I have to say. In the late 90s, early 2000s, everybody got excited about the advent of the internet. When you think about your life today, email, we have little computers in our pockets. I mean, we don't need encyclopedias. We don't need cell phones. We've got all that stuff on a little thing that's this big. If I had told you that 35 years ago, you say you're crazy. So everybody was excited, and they should have been. It's changed. It's changed everything. It's been huge for productivity. You guys remember when almost everybody had an assistant. Now we have one for 50 people. I mean, it's been a huge productivity increase. Did that prevent a stock market bubble that burst? It didn't, because there's winners and losers. So that's what's happening. This AI is
So you're predicting a bubble here.
Well, I'm saying that's what it's look. Now, let me say this. I want to say that. Am I negative on the stock market? I'm not. Why is that? I'm looking at it. First of all, that thing ran more than almost anybody thought. I mean, you remember there were firms who were no longer existing, getting pumped up without any revenue, and just because they had internet in their name. So I think it's early, actually. I mean, corporate profits are still strong, and importantly, the Fed's on a rate cutting side of things. And when you're in that environment, it's hard to bet against stocks. But I'm just saying that. Well, and the thing that I think that probably of all the things I said, the most important to remember is it's AI that's driving this economy. I mean, it counted for more than half the growth. This is investment spending, which is something like 20% of GDP, is really the driver. So, and when you're spending as much as they are, and keep in mind, if the spending just continues where it is now, you need an increase in it to keep pumping GDP growth. That's the point. So yeah, am I concerned? I am concerned. And when you add in the fact that massive fiscal and monetary stimulus that we employed, not only in the financial crisis, but much, much more so during COVID, that on the fiscal side has not been reined in at all. And on the monetary side, only partially reined in. And you've got, we've gone from $5 trillion of debt before the financial to 30 trillion. And, again, you look at this shutdown, even if the Democrats lose and they cave in or whatever, you're still talking about a bill that's going to increase things mostly with tax cuts. So I mean, it's hard. If you're looking at, let me put it another way. If you're looking at a couple of years, I'd be very surprised if we don't have a downturn at some point. But look, the Fed, the government has demonstrated. Why didn't we have a depression with COVID and with the global financial crisis? Because we had active counter-cyclical policy. It's just that when things are growing, you're supposed to rein that stuff in.
That's the part that we forgot about. But you're right. From my point of view, and Bob has articulated this very well, us having an independent Fed with a nearly unlimited balance sheet saved the economy during COVID.
Absolutely.
The only mistake was they didn't loosen the reins soon enough.
That's exactly
tighten the reins. Yeah, that's right. Sorry. Yeah.
Bob, turn to you for a question on an area you're an expert in, private equity. There's been comments recently by people I respect and follow, one being Chamath Palihapitiya, who said private equity is going to be very challenged going forward, that the asset class has had some strain on it and it's not likely to continue. Now, while you're in the private equity business now at Atlas Merchant Capital, you have very specialized funds where you bring expertise. For example, in your regional bank fund, you mentioned early on in this conversation that you have real expertise with David and yourself and Brian, who know how to operate in strong regulatory environments, that know how to manage financial institutions and the merger of them and the consolidation and that's a real specific expertise wrapped around a pool of capital to go and effectuate real plans. In a broader sense, are they talking more about the very large private equity firms that don't have specific uh, expertise in an area and are deploying that against a thesis? What do you think the future of private equity is?
I think it's fantastic. And I think, just as Larry said, if you look out over the next 3 to 5 years, it's very likely, or it's at least possible, we're going to have a correction in the economy, and it's likely we're going to have a
And that's
correction
okay,
in the
right?
equity market. That's normal. It's why we call it a cycle.
Yep.
And we've had this trend since 2008. So it's not necessary, but we'll be fine because we're investing privately. We're investing in companies that are profitable. We're investing where we see the ability to protect the downside while investing in companies that have significant upside. And that's why our current fund has a 35% IRR, why we've had realizations for our investors this year of over 100% of their capital, because we are more of a boutique. We're looking at billion-dollar funds, not 20, 30, $40 billion funds. And I think the confusion, Jimmy, sometimes is funds moving more toward broad asset gathering, but the ability to invest in the private sector, where Atlas Merchant Capital looks for companies with strong competitive positions, with strong leadership, with profitability, but also with both the willingness and ability to grow, where we are a catalyst for growth in the private markets. You couldn't find a better place to invest than private equity like Atlas Merchant Capital.
So going forward, it's sometime in the next couple of years, Larry expects that there could be a correction. He's not concerned in the short term about whether or not this holiday quarter will be a good one. He thinks that we've managed through the tariff question. We'll see. There'll be some inflation from that surely, but he's not concerned about a tidal wave on the brewing on the ocean here. But from a spend point of view, I do get concerned when I see a company like OpenAI, Larry, Bob, who are saying, okay, our valuation today is $500 billion. I'm going to take $100 billion from you over here. That at a 500 billion. So that puts us at 6. And I'm going to do a deal with NVIDIA for that 100 billion. Then I'm going to do a deal with AMD, and they're going to do it at a little higher valuation. Everyone gets to mark that up. That seems a little tippy to me.
Well, let's just separate the issues, Jimmy. One can be, as I am, very impressed by the progress in artificial intelligence, very positive on the impact it's going to have on productivity in the world, very impressed on how it's a dampener on other signs of inflation impetus. So it will be a counterbalance to some of that. But at the same time, there could be some things going on in deal making that can make some of the things overvalued for the current time. And I think you can believe both. Do I believe there are some signs that some of the accounting machinations that are happening could trigger higher valuations too early than is realistic? Yes. And at the same time, be incredibly positive on the impact of artificial intelligence on productivity in the economy. I believe both.
Well, that was a great summary and a great light shown there for me, Bob. Last question, Larry. We haven't talked about this yet today, but all the things that Bob just talked about require one thing in common: energy. Is when you talk about private equity piling into the energy space. Last topic, what would you say about where we are in terms of energy driven by this new demand vector?
Well, we came into it, okay, with plenty of energy. Look at what oil prices are doing. They're very low. And the economies are doing better than everybody expected. That tells you something. There's a lot of supply out there. This administration is making it easier to even have more supply. Um, I have to say, the margins aren't great for these guys because prices are so low and they're pumping it out. So the AI space is a little different because we're talking about computer capacity, but that relates to electricity and stuff. So it's this is something. One reason these numbers are going so high in investment is because of the excess demand. Whether the energy supply will be able to keep up, we'll see. But I think what Bob said, I think it's exactly right. I'm totally on board with what he said, that you can have a great technology like the internet, but that doesn't mean you eventually get overvaluation. And Jim, your point I thought was a great one. You look at some of these, and by the way, some of these transactions look even a little crazier in that some of the investments involve the other company buying back the services of the other company. So
or the chips.
And agreeing to buy their chips. Yeah. So that, that's like a bit of a Ponzi scheme almost. So yeah, I worry about.
But it is the fastest growing software company ever.
Exactly, and it's powering the economy. But I'm just warning that often doesn't end well. That's the point. But it doesn't seem to me in the late stage. I'm not seeing those signs of late stage. Corporate profits still look great. The Fed's now cutting rates. I mean, hard to bet against it at the moment. That's my point.
And Jimmy, you hit another good balance just to wrap this up, which is tremendous demand now for electricity for all of what's going on. Can you name an economy other than the United States of America more capable of reacting to that? And that's what we're seeing. I mean, it's so agile, so mobile. You're seeing a phenomenal adjustment to this economy to create that electricity to allow it to happen. Let's see how it goes. I think it's going to be a very interesting few years.
Especially for people with capital and private equity knowledge to invest in those spaces. Just saying. Anyway, guys, always a treat. Fall economic update call has been fascinating for me just in prepping for this over the last week or so. You guys bring so much to the table. Larry Cantor, the chief economist at Atlas Merchant Capital, Bob Diamond, the co-founder and CEO. Thanks for sharing your wisdom with us again this quarter.
Thanks, Jimmy. Thanks, Larry.